If you are an Australian pensioner, or someone you love depends on the age pension to survive, do not scroll past this video. What I'm about to show you is already affecting your payment right now, this August, and most pensioners have absolutely no idea it is happening. Some of you are going to watch this and realize your pension has already been quietly reduced without a single letter from Centrelink explaining why. Others are going to find out that a change buried in this year's federal budget is about to hit cover you have relied on for decades. And if you stay until the end, I am going to show you a loophole that could legally put thousands of extra dollars back in your pocket every year. One almost nobody uses because almost nobody knows it exists. Welcome back to RetireScope AU, the channel that cuts through government jargon and tells Australian retirees exactly what is happening to their money. Plain and simple. No spin. If this is your first time here, stick around, because the next 12 minutes could be the difference between a comfortable retirement and one where every fortnight feels like a fight. Let's start with the one that is quietly draining pensions right now, and almost nobody is talking about it. It is called Deeming, and if you do not understand it, it could be costing you real money every single fortnight. Here is what Deeming actually means. Centrelink does not look at what your savings actually earn. It assumes a rate of return on your financial assets, whether your money is sitting in a term deposit, shares, or a savings account earning almost nothing. And this year, that assumed rate went up. The lower deeming rate has climbed to 1.25%, and the higher rate has jumped to 3.25%. That is a half a percentage point increase on both tiers. For singles, anything over $64,200 in financial assets gets hit with the higher rate. For couples, that threshold sits at $106,200 combined. Think about what that means. Even if your money is sitting in an account paying you almost nothing in real interest, Centrelink is now assuming you are earning more from it than you actually are. That assumed income gets counted against your pension, whether you ever see a cent of it or not. If your savings sit anywhere near those thresholds, this change may already be quietly shaving dollars off your fortnightly payment, and you may not have even noticed yet. This is exactly why you need to check your own numbers today, not next month. Pull up your latest Centrelink statement and compare your financial assets against these thresholds. If you are close to the line, a conversation with Centrelink or a financial advisor who understands age pension rules could save you money you did not even know you were losing. Now here's where it gets even more personal, because this next part affects almost every single pensioner watching this video, whether you own your home outright or you are still renting. The asset test cutoff points changed on the 1st of July. And if your combined assets have crept up even slightly since then, through superannuation growth, the rising value of your car, or savings you have built up, you could be sitting closer to the edge than you think. For a single homeowner, your pension starts reducing once your assets pass $321,500, and it cuts off completely at $722,000. For a homeowner couple, that complete cutoff sits at $1,085,000 combined. And if you do not own your home, those thresholds are even higher, which sounds like good news, but it also means more people are being pulled into the assessable range without realizing it. Here's the part that catches people off guard every single time. This is not a gentle taper. Once you cross that top line, your pension does not shrink a little. It stops completely. And if you have a partner, remember, Centrelink combines both of your assets together, not just yours. Plenty of couples miss that detail, and it changes everything about where they actually stand. If you have not sat down and added up your house, your car, your investments, your super, and your savings against these updated numbers, that is homework you need to do the moment this video ends. Before we go further, if this information is new to you, and I have a feeling a lot of it is, do me a quick favor. Hit that like button right now, and if you have not subscribed yet, do it now too. Because Centrelink rolls out changes like this quietly, several times a year. And this channel exists purely to make sure you're never the last person to find out something that affects your own money. Now let's talk about income, because this is where a lot of pensioners who still work a little on the side get caught completely off guard. The income test thresholds also moved this year. Right now, a single pensioner can earn up to $218 a fortnight before their payment starts reducing. For couples, that combined threshold sits at $380 a fortnight. Go $1 over, and Centrelink starts clawing back 50 cents for every dollar you earn above that line, for singles, and 25 cents in the dollar for each member of a couple. If you are picking up casual shifts here and there to make ends meet, this is the number you absolutely need to know, because earning even a small amount over that threshold can shave real dollars off your payment without any warning landing in your letterbox first. Most pensioners only discover it when they see a smaller deposit hit their bank account and spend weeks trying to figure out why. But here is the good news I promised you, and I want you to actually pay attention to this part, because this is the loophole most pensioners never use. It is called the work bonus, and it lets you earn extra income without it touching your pension at all. Right now, pensioners can earn up to $300 a fortnight from work that is completely exempt from the income test. That is roughly $7,800 a year that Centrelink does not count against you. Here is what almost nobody knows. If you're not working, that unused exemption does not just vanish. It quietly builds up into a personal bank you can draw on later, up to a cap of $11,800. That means if you take on a short-term job, even for a few months, a huge chunk of that income, sometimes every single dollar of it, will not touch your pension at all, because you have been banking that exemption the whole time you were not working. If you have any unused work bonus sitting there, that is money working quietly in your favor. Keep track of it, because it could be exactly what you need if an unexpected bill lands on your kitchen table. Now, I need to tell you about something that has genuinely upset a lot of Australian seniors, and you deserve to hear it plainly instead of finding out from a letter in 6 months. As part of this year's federal budget, the government has moved to strip away the extra private health insurance rebate that pensioners and older Australians have received since 2004. Right now, if you are over 65, you get a higher government rebate on your private cover simply because of your age. Under the proposed change, that age-based boost disappears entirely, and everyone gets treated the same, regardless of how many decades you have paid into your policy. For Australians aged 65 to 69, the rebate is set to drop from 28% down to just 24%. And if you are 70 or older, it is even steeper, falling from 32% all the way down to 24%. Private Healthcare Australia has warned this could cost affected retirees hundreds of dollars more a year, on top of premiums that have already climbed over 4% this year alone. Now, this change has not hit your premium yet. It is legislated to begin from the 1st of April 2027, and right now it is still sitting in front of a Senate inquiry. But do not let that word proposed lull you into a false sense of security. This bill already has the government's backing and the clock is running. If you currently hold private health cover, now, not next year, is the time to sit down and work out whether your policy still makes sense once that rebate shrinks, because waiting until it actually happens will leave you no time to shop around. Look at your current premium, look at what your rebate will fall to, and weigh that against the cost of going without cover, including any waiting periods you would face if you ever needed to rejoin later. There is no single right answer for everyone, but ignoring this one is not an option if you want to protect both your health and your savings. Before we wrap up, I promised you something hopeful, and I meant it. The same budget that cut the health rebate also committed $1 billion toward the Support at Home program, and this part is genuinely good news. Starting later this year, the co-contribution that many seniors have been paying out of pocket for personal care services, things like help with showering, continence support, and daily dressing, is being removed entirely for eligible recipients. If you or someone you love relies on in-home support, that is real money staying in your pocket every single week. Contact your aged care provider directly and ask exactly how this applies to the care you currently receive, and when it actually starts in your area, so you do not miss out on a saving that is sitting right there waiting for you. Now, before we get to your action list, there is one more group of people watching this who need to hear this next part, and it is the group almost every pension channel completely ignores. If you're a self-funded retiree, or you hold a Commonwealth Seniors Health Card because you do not qualify for the age pension, do not switch off, because this affects you just as much as anyone on a full pension. On the surface, this sounds like good news. The income threshold to qualify for the Commonwealth Seniors Health Card has actually gone up this year to $90,000 for singles and $144,000 combined for couples. That card is not a payment, but it unlocks cheaper PBS medicines, a bigger Medicare safety net threshold, and depending on your state, discounts on power bills and council rates. Thousands of dollars a year, quietly, if you know how to use it. But here's the trap hiding inside that good news. Remember those higher deeming rates we talked about earlier in this video? If you hold an account-based pension, Centrelink deems income from that balance too, and it counts toward your Commonwealth Seniors Health Card income test. A retiree with a $300,000 account-based pension was being assessed at around $7,000 a year in deemed income. Under the new rates, that same balance is now assessed at around $8,500, an increase of roughly $1,500 in assessable income, even though not one extra cent landed in their bank account. If your income already sits close to that threshold, this quiet increase could be the exact thing that tips you over the line and costs you your card, along with every single concession attached to it, without a single dollar of real income actually changing. And because there is no assets test on the Commonwealth Seniors Health Card, most self-funded retirees never think to check their deemed income at all. They assume the higher threshold protects them, and they stop paying attention right there. If this applies to you, do not wait for Centrelink to send you a cancellation letter. Add up your account-based pension balance, apply the new deeming rates yourself, and compare the result against your threshold today. If you are within a few $1,000s either side of that line, A quick conversation with a financial advisor now could be the difference between keeping that card for years or losing it the moment your next review comes around. So here is exactly what I want you to do the moment this video ends. Check your financial assets against the new Deeming thresholds. Add up everything you and your partner own against the updated asset test cutoff points. Know your income test threshold if you are earning any extra money on the side. Start using your work bonus if you are not already banking it. And sit down with your private health insurance now before that rebate cut becomes real. None of these changes were shouted from the rooftops. They rolled out quietly, the way almost every pension change does, buried in press releases most pensioners never see. That is exactly why this channel exists, so you are never the one finding out too late. If this video helped you, hit that like button right now. It genuinely helps this reach more Australian retirees who need to see it. Drop a comment and tell me which of these changes caught you the most off guard. I read every single one. And if you want to stay ahead of the next update before it quietly hits your payment, subscribe to RetireScope AU right now, because there is more coming and you do not want to be the last to know.